50 ships carrying Brazilian coffee were turned back from U.S. ports in a single night. Millions of pounds of beans rejected on arrival as a new 50% tariff slammed into place. For the world's largest coffee-drinking nation, the effect was immediate. Prices spiked, supermarket shelves thinned, and cafes scrambled to secure supply. Overnight, America's daily ritual, relied on by 67% of adults, was thrown into crisis. And while U.S. buyers froze in uncertainty, China seized the opening, signing billion-dollar supply deals with Brazil at lightning speed. The question became unavoidable: who owns your morning cup now, Washington or Beijing? Brazilian exporters kept loading ships regardless, because the harvest moves on its own clock. Warehouses at Santos couldn't absorb diverted beans forever. China acted fastest, adding 183 Brazilian exporters to its approved list, granting 5-year permits in record time. Normally, such approvals take months, buried between routine plant health notices. At the same moment, Shanghai cafe chains rolled out new promotions, iced lattes bundled with bakery discounts, nudging younger consumers into deeper habits. Elsewhere, Canadian importers increased inquiries for September and October arrivals. Their contracts carried no tariff risk, and they targeted mild Arabica beans suitable for retail blends. U.S. buyers weren't so lucky. Prices had already been rising through July, and when the tariff hit, scanner data showed double-digit shelf increases across major supermarkets. Roasters could only pass along part of the cost because private label contracts capped quarterly resets. Margins shrank, and one major brand disclosed steep cost increases that flipped its quarter into a net loss. On the earnings call, executives singled out coffee as the main culprit. Independent cafes had it even harder. Wholesale offers jumped by a third in one update. Owners warned baristas that hours might be cut until new blends stabilized both taste and cost. Meanwhile, Brazilian producers watched domestic spot prices wobble as export channels pivoted. Co-ops reminded farmers that this was temporary. Asian demand would soon lock in multi-year volumes. Already, weather troubles in Vietnam and Brazil had squeezed supply earlier in the year. The tariff landed on top of a hot market. In August, New York Arabica futures rose more than 25%, while London Robusta jumped even more as instant coffee makers scrambled to secure beans. Brokers said volatility widened because agronomic models can't forecast trade wars. Inside U.S. roasteries, blend sheets were rewritten. Robustas and Central American origins replaced Brazilian beans, but customers noticed immediately. Drip drinkers complained of bitterness. Buyers rushed to Honduras and Ethiopia for incremental lots, only to find offers priced higher. Colombian exporters refused forward commitments, wary of locking in sales against a moving price curve. Logistics teams rerouted cargoes through Gulf ports to balance East and West Coast demand, and trucking surcharges crept higher as fuel costs rose. In Brazil, the cabinet launched a formal review of retaliatory measures. But officials emphasized diplomacy first, a calming signal that steadied the reel. Export councils argued that the global market would absorb the beans even if the U.S. stepped aside. They pointed to China's exploding cafe scene as a structural outlet. European buyers pressed for calendar year contracts with firm tonnage and price ceilings, while Brazilian shippers added calls at Qingdao and Ningbo to accommodate rising Chinese demand. For context, Brazil is America's single largest coffee supplier, accounting for about a third of imports. Losing that anchor forced U.S. roasters to choose between higher costs or lower quality. Big chains cushioned the hit with long-dated hedges and global footprints, shifting promotions toward food where margins offset beverage pressure. Small cafes had no such luxury, and customers immediately tasted the difference when Brazilian Arabica disappeared. Cafe behavior shifted as well. Urban commuters began buying earlier in the morning and bundled pastries to justify higher tickets. Economists noted that tariffs act less as supply shocks than demand destruction. Consumers ultimately pay when a country imports virtually all of its supply. In Washington, critics of the tariff argued it was effectively a consumption tax on households. Advocates countered that foreign suppliers could absorb some costs to preserve share. Early data gave no clear answer. Some invoices showed pass-through, others didn't. Much depended on brand power and timing. On trading floors, analysts noticed something bigger. China's coffee demand is growing at multiples of the global rate. If Beijing locks in 5-year contracts with Brazil during America's pause, will U.S. roasters ever reclaim that volume without paying permanent premiums? That matters because Brazilian Arabica provides the mild, sweet flavor base most blends rely on. Substitutes carry taste penalties that blind panels detect quickly. If American brands drift for long enough, loyalty could reset around new profiles. Hard to reverse once consumer memory adjusts. The USDA had projected record world coffee production in 2025/26 before tariffs. But supply chains weren't built for sudden rerouting. Brazil's crop leaned heavily on Robusta, complicating substitution for U.S. roasters who depend on Arabica milds. By late August, Arabica futures touched multi-month highs, triggering circuit breakers as speculative options activity spiked. Warehouse congestion slowed certification paperwork, while some distributors lost credit lines until forecasts were updated. Brazilian co-ops redirected flows to Asia and Europe, pitching consistency and scale. Chinese buyers bundled coffee shipments with other agricultural imports to secure discounts. European retailers streamlined product ranges, while Canadian chains held prices steady, attracting U.S. consumers shopping across the border online. Back in Washington, food sector groups lobbied for carve-outs, framing coffee as essential. But the administration signaled no timeline for reconsideration. Analysts treated the tariff shock as manageable for global giants, but existential for small independents. Private equity swooped in on struggling regional roasters, buying brands at distressed valuations. Brazil's economy proved resilient. Coffee is important, but minerals, meat, and manufacturing drive its export base. Still, the symbolism mattered. Coffee is a ritual Americans see as their own. Public opinion then split between those who saw tariffs as leverage and those who saw only higher household costs. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.